Välkomna till Kungliga Vetenskapsakademin och den här presskonferensen då vi ska presentera Sveriges Riksbanks pris i ekonomisk vetenskap till Alfred Nobels minne för 2022. Welcome to the Royal Swedish Academy of Sciences and this press conference when we will announce this year's Sveriges Riksbanks prize in economic sciences in memory of Alfred Nobel for 2022. We will keep to our tradition and begin the presentation in Swedish, and then we will take it in English. And you are, of course, welcome to ask questions in either of these languages afterwards. Jag heter Hans Ellegren och är ständig sekreterare här vid Kungliga Vetenskapsakademin. Till höger om mig sitter professor Tore Ellingsen. Han är ordförande i kommittén för Sveriges Riksbanks pris i ekonomisk vetenskap till Alfred Nobels minne. Och till vänster, professor John Hassler, ledamot i priskommittén och sakkunnig i ämnet. My name is Hans Ellegren. I'm Secretary General of the Royal Swedish Academy of Sciences. And to my right is Professor Tore Ellingsen. He's chair of the committee for the Sveriges Riksbanks prize in economic sciences in memory of Alfred Nobel. And to my left, Professor John Hassler, member of the committee and expert in this field. Årets pris handlar om banker. This year's prize is about banks. Kungliga Vetenskapsakademin har idag beslutat att utdela Sveriges Riksbanks pris i ekonomisk vetenskap till Alfred Nobels minne för 2022 i lika delar till professor Bernanke, the Brookings Institution, Washington DC, USA, till professor Douglas Diamond, University of Chicago, Chicago, USA, och till professor Philip Dybvig, Washington University in St. Louis, USA. Det tilldelas priset för forskning om banker och finanskriser. The Royal Swedish Academy of Sciences has today decided to award Sveriges Riksbanks prize in economic sciences in memory of Alfred Nobel for 2022 to Bernanke, the Brookings Institution, Washington DC, USA, Douglas Diamond, Washington University in University of Chicago in USA, and Philip Dybvig at Washington University in St. Louis, USA. They obtained the prize for research on banks and financial crises. Professor Tore Ellingsen will now give us a short summary of the field. Please.
We didn't know it at the time, but 15 years ago, much of the world stood at the brink of a devastating economic crisis. Most of us were unprepared for it. However, a few academic economists were both prepared and worried. They had studied the theory of bank runs. They believed the evidence in its favor, and they suspected that the possibility of runs was yet again becoming relevant. As events unfolded in 2008, 9, and 10, new evidence piled up in favor of the theory. In a nutshell, the theory says that banks can be tremendously useful, but they are only guaranteed to be stable if they are properly regulated.
Thank you, Tore. I now leave the word to Professor Hassler, who will give a more detailed presentation of this year's prize. Please, John.
So banks are for basically all of us a part of daily life. Most of the time, banks and the banking system works well, but sometimes part of it, or perhaps even the whole system fails. Banks go under, and a self-propelling downward spiral can start, leading to catastrophic consequences and even financial crisis. So financial crises are dramatic events. people run to the banks, bank runs appear. This can lead to banks failing, and this can spread like a wildfire to other banks and actually to the rest of the world. And we know that the consequences of these series of events are very dramatic, and they can also be quite long. We have seen these things happening in history many times, but we have also seen that it can happen during modern times in our economy today. So when you think about the consequences of financial crisis, and in particular about the central role that banks play, many questions arise. Couldn't we do without banks? Do we really need to have them? Is it the case that banks are inherently unstable, or is there some flaw in the construction of banks that could be fixed? When banks fail, couldn't new banks quickly arise, taking over the old customers so that the economy could start to be operative quickly again? And we also hear that banks create money. Is that even legal? And when we think about the consequences of bank runs and bank failures, wouldn't it be possible to change the system, to introduce measures that make the system more stable so that we don't see these dramatic events? Modern banking theory addresses and answers all these questions, and it rests on 3 fundamental contributions by the laureates this year. So let me now start to talk a little bit about the actual contribution that we recognize today. So Bernanke, in a paper from 1983, showed with statistical analysis and historical sources that bank runs led to bank failures. And this was the mechanism that turned a relatively ordinary recession into the depression in the 30s, the world's most dramatic and severe crisis that we have seen in modern history. So he showed that banks need to be there. They need to be up and running for the economy to work. And if they don't, then the economy works worse, much worse. During the Depression, the income and production plummeted, the unemployment skyrocketed, and as we know, the whole thing spread to the rest of the world. At the time when Bernanke published this, this was a break with the current views. Of course, people had seen that banks failed, but it was more thought as a consequence of the crisis rather than a cause of the crisis. But now, the views of Bernanke have become the conventional wisdom and has received lots of solid empirical report during later times. Diamond and Dybvig, in a paper in 1983, showed that banks are perfectly constructed to make sure that savings are transferred to productive investments. They do that by stepping in as an intermediary, a middleman, solving a quite natural conflict between savers and borrowers. And that conflict is that borrowers, they want to have liquid assets. They want to have access to their savings, while, so did I say borrowers? Of course, I mean savers. They want to have access to their savings all the time. And on the other hand, borrowers that make investments in, say, homes or in factories, they need to have a long-term commitment. So banks step in by doing what is called maturity transformation. And they then accept deposits from savings that savers can have access to continuously, and they transform that into long-term assets, the lending to households and firms. So in a sense, you could say that this is creating liquidity, creating money, not from thin air, but from the long-term assets, the lending that the banks do. So this was part of the paper. What they also show in this paper is that this maturity transformation is inherently vulnerable. If a rumor starts that people are going to take out their money from the bank, then everyone has an incentive to rush to the bank to take out money in time and not come last in line for taking out the money. And this can create failing banks. And this is something that's inherent in the maturity transformation. So maturity transformation is important, but it's also vulnerable. Diamond, he showed that banks are also perfectly constructed to serve another important purpose, and that is to monitor the borrowers. And they do that on behalf of the savers, again, as a middleman between, an intermediary between the savers and the borrowers. So banks can do this in an efficient way, reducing the cost of credit and making it possible to finance more productive investments in society. A problem with this is that this monitoring requires knowledge about the borrowers. This is built up during the relation with the bank. And when the bank fails, this knowledge disappears and cannot easily be transferred to other banks. And that is why it's difficult for new banks to take over the old customers. And this is a reason for why banking crises tend to have very long-lasting consequences. So what's the importance of all this for society? Well, as I said, the laureates have provided the foundation for our modern understanding of why banks are needed, why they are vulnerable, and what to do about it. So in the laureates' work, it's shown that deposit insurance is a way of short-circuiting the dynamic behind bank runs. So with deposit insurance, there is no need to run to the bank, and bank runs don't really need to start. They also show that liquidity provision, lending of last resort from the central bank is a way of dealing with this. So the ideas that we today recognize have proven to be invaluable also in modern times. During, for example, the financial crisis, when the laureates' work turned out to be important to understand what was the cause of the crisis. And during that time, by the way, also one of the laureates, Bernanke, was the head of the US Central Bank, the Federal Reserve. So the measures that were undertaken rests on the ideas that we recognize today. And we can also note that even though the financial crisis had large consequences, neither that nor the COVID pandemic led to depressions like in the 30s. So society is changing, and financial markets too. New agents come up, new financial instruments come up all the time. But the need to construct rules and understand the financial markets in order to reduce the risk of financial crisis and to prevent them into turning into depression, that need really remains a first-order priority. And the laureates' work, despite being actually 40 years old, still remains an important ingredient in that endeavor. Thank you.
Thank you, Professor Hassler. Let's see if we have one of the laureates on the phone with us. Do we have Professor Diamond with us on the phone from US?
Yes, I'm here.
Good morning, Professor Diamond. Congratulations to the prize.
Thank you very much.
I'm sorry that we have to wake you up rather early in the morning. Did receiving the prize in economic science came as a surprise to you?
It did come as a surprise. I mean, people always talk about these things, but I was sleeping very soundly, and then all of a sudden off went my cell phone.
Okay, yeah. I'm sitting here in the session hall of the Royal Swedish Academy of Sciences, and we have an ongoing press conference. Would you be ready to take some questions from the international press, including journalists and national media?
Yes, that would be great.
We have one question there, please.
David Keaton from the Associated Press. Congratulations on this prize. We cannot think about the banking sector without thinking about what is happening today with increasing interest rates. As a Nobel laureate today, do you have any warnings to banks and institutions and governments around the world when we're seeing sort of a financial crisis, impending financial crisis on the horizon?
So financial crises, as the way that Phil Dybvig and I think about them, become sort of worse when people start to lose faith in the stability of the system. And that is all related to basically how profitable they think the banking sector is, and how, in addition to being stable. So in periods when things happen unexpectedly, like I think many people are surprised how rapidly nominal interest rates have gone up around the world, that can be something that sets off some fears in the system. We saw some of this in the United Kingdom in their liability-driven sector of the insurance market. So that, I guess the best advice is to be prepared for making sure that your part of the banking sector is both perceived to be healthy and to stay healthy, and to respond in a measured and transparent way to changes in monetary policy.
More question, yeah, please.
Annika Andersson, TT News Agency. Hello, Professor Diamond. I would like to ask, do you believe that the current financial crisis can end up to be a financial crisis as the one we had in 2008? And if so, do you believe that we're better prepared this time? Thank you.
So let me start with the second part. We're certainly much better prepared. I think before the 2008 crisis, there wasn't, a general perception in the financial sector and in the regulatory community that there was, an unusually high vulnerability to the sector. And the fact that the losses in the 2008 period sort of started within the financial sector, in the mortgage and banking parts of the financial sector, made it particularly bad. Since then, both recent memories of that crisis and improvements in regulatory policies around the world have left the system much, much less vulnerable. In the United States, in the European Union, and the UK, all of the regulations, and in Asia, all of the regulations have been much more attuned to the current world. And the banking sector, it seems like around the parts of the world that I'm well aware of, seems like the banking sector itself is in very solid shape, good net worth, good risk management. The problem is that these vulnerabilities of the fear of runs and dislocations and crises can show up anywhere in the financial sector. It doesn't have to be commercial banks. And the key insight that Phil Dybvig and I tried to make in our paper on bank runs is that it's not so much about banks, it's not so much about money or creating money, it's about issuing short-term and liquid liabilities, like deposits in the case of a bank, or shares in the case of a mutual fund, which are much more liquid than the underlying assets that they hold. So this mismatch between the liquidity of assets and liabilities can occur in the insurance sector, as we saw in the liability-driven parts of the UK, and that there the mismatch came from when interest rates went up, there were calls for more collateral from these insurance companies. It can occur in the banking sector, it can occur in the mutual fund sector, it can occur various places. And the current situation probably will see, and it can even occur in the firm sector, the current situation will probably be a bit different from 2008, just because the banks themselves are in quite good shape.
Okay, we have a question here.
Hi, Professor Diamond. This is Nordic Chinese Times. Congratulations on the prize. I would like to ask about, do you think central banks will be capable of bringing down inflation given the debt levels and because of inflation is supply side driven? And my second question is, do you think cryptocurrencies will replace the banking system or can be a threat? Thank you.
So let me start with the first one. So I'm not an expert in monetary policy, but I'm used to be a macroeconomist when I was in graduate school. Now, I think the central banks will indeed be successful, and if they want to be, it seems like many of the central banks really want to be successful and are willing to stick to their commitment to get back to their inflation targets. I think they will be successful. I think we often forget a famous quote from Milton Friedman that monetary policy has long and variable lags in its effect. So I think that some of the current discussion about, well, let's say in the United States, the Federal Reserve Open Market Committee has raised interest rates and inflation hasn't fallen. We wouldn't expect that to happen in any case. It would take quite a good while for inflation to actually respond to monetary policy. I think they can indeed be successful, even though as you mentioned, part of the problem is very large deficits on the fiscal side across the world. Both monetary and fiscal policy have to be properly aligned to get inflation in control. But I have no doubt that they can get inflation under control. And I recall there was a second part of the question, which I've now forgotten.
Maybe we should actually move on.
Okay.
We have several questions in the audience, so maybe we should move on. We have one here, please.
Okay.
Professor Diamond, could you hear that question?
I could not hear it at all.
No, I think the microphone was off here. Make it short, please.
Yes. Your colleague Kindleberger has said that to always intervene is just as crazy as to never intervene. But do you think it was the right decision to let Lehman Brothers go bust in 2008?
So that is a very difficult question. Many people have done postmortems on the Lehman Brothers event. So probably in the last analysis, I think it probably would have been better if Lehman Brothers had not collapsed unexpectedly, in part because it seemed like the benefit of letting them collapse was that it would somehow prove that the regulators were so tough that it would act to deter future problems. Then very quickly thereafter, we had In the United States, we had the problem with AIG, which was needed intervention. So once you put those two things together, if we knew the second was going to happen when we did the first, it would have been better to find a more accommodating way, a less unstable and unexpected way to resolve Lehman Brothers. That said, there's a lot of question on the possible legal the legal ways that the U.S. Regulators could have resolved Lehman, and some claim that it was essentially impossible for them to do it. But had they found a way, I think the world would have been had less of a severe crisis than it did.
Time is running here, so we have one more question. SVT.
Jonas Olin, SVT. Is it possible to avoid financial crisis?
I mean, it is possible to. That's part of the point of the work of mine with Phil Dybvig. Is it is indeed possible to avoid financial crises. There are ways that one could write contracts and set up the financial system where there was never ever a crisis. The point of our work is that that's probably not the best thing to do, because in many circumstances, the very thing that leaves the financial system subject to a crisis is creating more liquid assets that savers would like to hold out of less liquid assets, longer-term illiquid assets, physical plant and equipment, things like that. And it's very difficult, although not necessarily impossible, it's very difficult to have both the creation of extra liquidity that the financial sector does combined with universal financial stability, which means the lack of financial stability is a financial crisis. So you need, the financial system as a whole needs very careful contract design to minimize the chances of a crisis, given that they leave themselves in this vulnerable position of relying on some confidence. They need to be careful themselves. They may need to have, because there are various externalities in the system, or where what one player does affects the outcomes of another, there needs to be some regulation. And there may even need to be something like deposit insurance or ex post bailouts. Even though these bailouts have problems, they, just like I mentioned in Lehman Brothers a minute ago, they could actually be good for society. So it's possible, but it's not necessarily desirable to never have a financial crisis. I think we will probably always be subject to low probability, unexpected crises.
Thank you.
Okay, Professor Diamond, once again, our warmest congratulations. We look forward to meeting you here in Stockholm in December at the prize ceremony. Again, congratulations and goodbye for now.
Goodbye.
Okay, let's move on. We have a couple of minutes. Let's move on to see if there are some questions to the committee here. You can ask either in English or in Swedish. Are there some questions to the committee? I don't see that. So then let's close this press conference. We thank you for your interest. We hope to see you again in December when we'll have this year's laureates prize lectures. That will be on December the 7th here in Stockholm, when there also will be a press conference. So thank you for attending.